consumer softness on discretionary items, though. That has been the trend for retailers this quarter. For more, let's bring back in Rick Rieder, BlackRock Global Fixed Income Chief Investment Officer. Not sure what your stance is on ripped jeans or holy pants, but
I still wear ripped jeans. Is it out of style? I don't know. I like if they're comfortable.
I guess they're good for lawn work, too, sometimes. But, at the end of the day, when you kind of think about the health of the consumer right now, we've continued to hear time after time again, whether it's from the banks to start off this earnings season, that household balance sheets are just fine, whether it's, some of the core categories that consumers have to buy into necessities, they're saying that the consumer is resilient. But now once you get into some of these discretionary categories, it's a different picture that's being painted.
So listen, I think the consumer is still in pretty good shape. I mean, a 3.5% unemployment rate with good wages, and you've had savings rates. It's coming down, but savings are still, you still have $1.5 trillion in savings. So I think this consumer is in a good place. When you break it down, you look at what's happening in travel and leisure, consumers are definitely moving more to experiences. I think that is a cultural shift. And coming out of COVID, they spent an awful lot on goods, an awful lot on apparel, an awful lot on electronics and furniture. That has been, you don't need to do that again. And so I think there's a shift at play. And so we went through credit. We go through a ton of credit card data to understand what's happening in the world. We went through it today. The bifurcation between, and this gets back to the Fed and what's happening, lower income is struggling. Higher end is doing, middle to higher end is actually, the consumer is doing quite well today. It's again, higher interest rates, you buoy savings for those that are savers. But it's the lower end that's tricky, and then it's having a harder time. So there are a ton of trends underneath the surface, and you're seeing that play out in these earnings numbers.
So I wanted to zero in on something you said earlier that also caught my eye yesterday from the Macy's statement, where they talked about delinquencies, credit because they have store cards, delinquencies on those cards ticking up more quickly than they anticipated. So this morning I was looking at the overall delinquency numbers. We have them up on the screen. This is only as recent as the second quarter. I don't think we have fresher data than that. You see it's starting to slope up again. It's still kind of in line with where we were pre-pandemic. And then I was also looking at the non-housing debt for households, right? And those are also going pretty much up into the right across the board. So in this period of rising rates, how high are those delinquencies going to get? How much is spending going to get pinched as a result of this heavy debt load?
Yeah, I mean, it's going to pick up. I mean, my sense is the consumer, so if you think about what's happened in the last few years, the consumer generally has delevered, paid down the home. They've generally, if you're starting from a base of credit card borrowing, that's still pretty low. So consumer is still pretty delevered relative to it's been in history. And this is why you're having this big bifurcation. It's the lower end. And this is part of, this dynamic. If unemployment starts to tick up, that's when you're going to start to see it. There's another very interesting thing that you don't see over time. Consumers have locked in their mortgages at 3%, 3.5%. So you see housing activity is incredibly low. So let's just say unemployment starts to tick higher, and then all of a sudden people have to sell their homes where the mortgage rate is too high. This is where you can get into a really tricky period. Part of why I think we need to stabilize here and let things settle in, because that becomes difficult, because today people are not stressed by their mortgage payments, and they've already locked in these mortgages. That's why you see the housing, existing home sales so low, is you can't sell your house today. But what if you had to?
Right.
That becomes tricky.
So when you talk about the lower end consumer, presumably that's also the consumer that is now more stretched in terms of taking out credit card debt, for example.
Definitely.
What you're describing in housing, that would be something potentially that would affect higher income consumers.
It would, but it's still, yes, but I still think it's in the lower income strata that becomes tricky. And if you go back to where you had real pressure on the economy, whether it's the financial crisis, it was driven to a large extent by pressure on the housing market. You go back to the savings and loan crisis. What's happened here, and this is this dynamic about interest rates, it's really hurt the commercial real estate market. Commercial real estate is not a big structural problem to the economy. We think it hits capital 30 to 40 billion total. It's not that big a deal. If you hit the housing market, 3/4 of the wealth in the country is in people's homes. If you hit the housing market, that becomes a really tough thing. Heretofore, you haven't had that with mortgage rates escalating like they have, because people just stopped selling, and their employment dynamic is good. This is why we got to be really careful. I don't believe in the thesis, the way to get inflation durably lower, let's see if we can deteriorate the unemployment picture in the country. I just think it's wrong today, given different dynamics than we've seen versus historically.
Really interesting stuff, Rick. We've got to leave it there. Thank you so much for being here. Rick Rieder, BlackRock Global Fixed Income Chief Investment Officer. Thanks as always. And thanks for coming in the studio. Good to see you in person. Love it.